extremely basic options introductions. This is an entire rabbit hole that we can spend hours and hours of videos and days upon reviewing. This is at the end of this video, you will be able to place basic option contracts and purchase them, be able to exercise them, sell, know what is better, implied volatility. You'll be able to know a lot of things: theta, delta, gamma, call versus put, right? Not by application, premium, expiration date, liquidity, a lot of different things in here that you need to know. But disclaimers, we will be getting into the disclaimers at the end. Firstly, call versus put. A call is a bet thinking that the stock will go up. A put is the exact reverse. You place a bet thinking that the stock will go down. Example, so on Webull here, there is a link for Webull if you want to trade with them and have this awesome option spreadsheet here. They have everything that you need. They have all the settings that you want to change. Okay, you can customize this to be however you want. Now, obviously, this is going to be blowing your mind if you're a beginner, but we're going to break everything down in simple understanding. Take some notes, get your notepad ready. I'm serious. Watch it twice, whatever you have to do. Calls and puts. Here's your calls. Here's your puts. If you want to buy a call, one thing you can do, click whatever strike you want. We're going to get into the how you actually do this. But if you want to pick an in the money option here, okay, let's go to 5. Let's hit the ask. There you go. You can change your expiration date. Anyways, we're going to get back more into the specific examples, but that is the basics between picking between calls and puts. That's what they look like. That's your example. Right to buy, but not an obligation. That's what an option is. It's a contract. You're paying money to acquire the right to buy, but not necessarily, you don't necessarily have to, right? That's why we say, but not an obligation. Not an obligation means you are forced to. It's basically a requirement. No, it's not a requirement whatsoever. You can have options expire worthless. You can never sell them. You can exercise them. You can sell. So there's several things you can do in regards to options. We're going to get into that. The premium and expiration date. So the premium is what you're going to pay to acquire that right to buy, and the expiration date is how long you actually have until that option will expire, of course. And there is a lot of important implications and ramifications for this. For example, the theta is something that is going to basically act as a time decay, aka depreciation, if you are purchasing an out the money call option. And that sounds super advanced and complex. It's really not that hard. You can understand at least the basics at the end of this video. I'm going to explain all this in simple language. So to review so far, if you're confused, call goes up, put goes down, right to buy, so you can get a call option. And remember, you don't have to necessarily sell or exercise anything. You don't have to buy shares. You could sell the option because it's not an obligation. Premium and expiration date, these are two things that were, okay, let me just go over an example of how you change these things and a little bit more in depth on these. So the premium, again, it's what you pay to acquire that share price. And as you guys probably are, some of you probably know, as you get further into out the money, right, as you go from, for example, let's just go, you know what, let's just pull let's just focus right here so it's not as intimidating. Okay, so these are in the money call options. So basically, we're going to get into money. But as you go more out the money, further away from the share price, right, you can see the share price 697. Share prices that are above the current share price. As the farther you go out, the lower the premium is. If we were to hit on this ask right here, your premium here, estimated premium debit here is going to be $310 for 10 shares or 10 contracts. If we click on this one, your premium is going to be $520, right, for the same amount of shares. And it's the same thing. The higher we go here, because the ask is a little higher on each one, it's going to be, the premium is going to be higher, right, because these are less risky. The further in the money you go, essentially, the less risky it is. But more on that, right? Look at this estimated premium, $1,400. Holy crap, why wouldn't I just pick this one? Well, we're going to get into the downside of picking one with a low premium too. So you have to be very careful with options, guys. Please watch this video several times and take notes if you don't know what you're doing and if you are confused this far. Liquidity. This is something that no YouTuber says for some reason. No one really, there's not that many great options videos out there. We can go more in depth on some options later. I'm not an options guru, but I understand the basics, and I guess a beginner would not consider this stuff basics, especially the delta, gamma, and theta. But liquidity. So when you are on Webull here, you're going to have to customize your widget here a little bit, but you want to have volume. You want to have that there because you do not want to get caught buying an in-the-money option, a strike price of $4 for buy on Nano, for example, with a volume of 19, as opposed to something with similar premium, similar risk, right? Like the 5 or 6 strike price with a lot more volume, because that liquidity is going to come into play when you're trying to sell your contract option. Which, as we're going to get into, selling your contracts are going to be typically, not always, but most often, they are going to be more lucrative and more rewarding profit-wise as opposed to exercising and buying the shares at whatever strike price you have there. So next up, so also risks and most auspicious level. Yeah, so typically just in this, if you're a beginner, you don't know what the hell you're doing, it's okay, guys. Start off with something simple. Start off with an in-the-money option, and by the end, you'll understand more already. But pick something with a fairly high volume relative to everything else. Also, try to stick with stocks when it comes. Not all stocks are options. Not all stocks have options available, and not all brokers have options available, which is why I recommend Webull. Link in the description. Quick plug. The volume in here, the higher it is relative to the other ones, the better and more safe you will be. That is typically what you are going to be. So auspicious level, high volume is going to be. So implied volatility and returns, in the money and out the money. Sounds like a heck of a lot to explain. If you're a beginner, you're like, oh my God, what is going on? Brandon, my brain cells are evaporating right now. I've been there, my friends. I learned this the hard way. I was in your situation right now. If you're confused right now, it's okay. So in the money, right? All that in the money means is that it is the strike price is below the current share price. And also another thing to note, this might not be the best time to say this, but I got to say this because it's important. The options here, you can't trade options after hours or pre-market, and the share price here, it's going to be the closing. So if we look at the closing price here, 697 is what we closed at. Okay, so the option here, it's going to be 697, the exact same close, right? So that is something that you cannot place options during the pre-market after hours, nor can you sell or exercise any option contracts in the pre-market and after hours. It's completely exclusive to during the market time. So implied volatility and returns plus in the money and out the money. So typically the concept I want you to understand here is that number one, write this down, please. The strike price in the money just means that the strike price is a little bit below the current share price. So 654, all of those strike prices are going to be below the 697 closing price of BioNano for 28th of April. And the 789 here, these are going to be out the money contracts. 7 is considered at the money, actually, technically, because it's right at the share price, essentially. That is typically orthodoxly going to be considered at the money. And these 8, 9, these are going to be considered out the money. And what you need to understand here, implied volatility here. So basically, as you can see here, essentially, the farther you go, basically, the more volatility there is going to be implied. Now, essentially, I don't really want you to focus so much on this. I just want you to focus on what I'm saying here. The farther out the money you go, essentially, not always, but basically, I'd say pretty much always, the more riskier and the more potential reward you have. Okay, so basically, the farther out you go in terms of strike price, the farther away you go, the lower the premium, the higher the reward chance. So you may be thinking, wow, so I get less money to pay on the premium and higher reward. That's awesome. I'm going to do that all the time. But here's the kicker, guys. The risk and the chances of success are the chances of success are much lower and the risks are much higher, because in order to get that by your expiration date, but right here is the 21st of May, right? That's less than 25 days away. So BioNano would have to hit $9 a share. So that's, what is that, 20-30% increase in like 25 days. Of course, you're going to be, let's see what your estimated premium is, only $310 compared to if you were to buy the 141 ask on the 6 strike price expiration 21st of May, which is going to be $1,400, right? So it's a lot better in terms of that, but are you actually likely to be able to sell that at a profit or exercise it in a profitable way? Not as much, of course, not as much, guys. So basically, if you didn't understand any of this, please take notes, please watch other options videos. Do not, and please also, if you are watching this video, quick disclaimer right now, skip to the edit on screen if you're not confused at all. But I am not an options guru, and you need to watch and do other research in options before you do options trading. Now, I think it's fair to say that if you understand this video, you can go out and place simple single call and put options, specifically calls. I would not recommend puts, but single call options are fine for you after you watch this video if you know what you're doing and you are an experienced trader. Please realize that, my friend. We're not going over any of these other ones, okay? Because we're just not ready for that yet, my friends. And some of these, I'm going to be honest with you, some of these, I don't even know what some of these mean. I'm not an options guru. As I said, I understand the basics. I can explain it to you, but I cannot give you a full hour breakdown on everything you need to know about options. So in the money is below the strike price, less risk and less reward. Out the money means more risk, more reward, and less premium. And this one has a higher premium. Also, out at the money. I'll go ahead and add at the money, I guess. So this is what it's basically. This is basically what the share price is at right now. That's kind of the middle ground. It's kind of the middleman area. You can get a little bit of risk, a little bit of reward, right? And a balanced premium essentially. So basically this 6 point, I basically already spoiled that. Cat's out of the bag on that one. That's exactly what we talked about here. So selling or exercising. So I already told this one as well. So typically you want to sell your options contracts in my experience. Selling is generally more lucrative. There's not many times where you want to exercise them, but if you want shares, if it's a company that you really like and you think you're not going to be able to add shares ever at whatever strike price you have, and you want to exercise, you want to get some, you lower your cost basis, whatever you think it's going up, right? And your call option, it's going to expire or whatever. Exercising is not a horrible option, but generally, if you don't know what you're doing, I would just recommend sticking with selling. So definitely keep that in mind. Depreciation. This is when it gets complicated. This is when it gets really scary and risky. In the money versus out the money. You do not have to worry about depreciation if you are in the money, my friends. If you are out the money, you are going to have this little bad boy called theta against you, working against you. If we come over here, the theta right here, this is the thing that kills you, right? This is basically, just think of it as a graph, right? When you get your option, you're right here, right? As time goes on, if it's an out the money contract, your value of that contract is going to go like this. It's going to go down. So basically, you want to sell. So basically, not only is there higher risk and a less chance of success with out the money call options, but there is a lesser time frame for actual profitability, right? Because you're getting that time decay, otherwise known as depreciation on that call contract. So I want you guys to keep that in mind, and we are going to get into the actual definitions of this, but I want you to understand, if you don't know what you're doing, I would just recommend going with at the money contracts or call options or in the money, okay? Because it's just more safe than out the money. If you don't know what you're doing, just stay away from that, I would say, until you get to know your way around things. So this is going to go right over your head, most likely. It certainly went right over my head the first time I was getting into options, my friend. So delta compares the change in the price of an underlying asset with the change in the price of a derivative or option. All right, it's like, what in that bread? And I'm giving up. I'm done. I'm going to another option video. My friends, I'm going to tell you exactly what you need to know down here. Basically, this is all you need to know. But basically, I want to go over the actual definitions here because they're very complicated. They're very hard to grasp, and they're very complex. I'm not going to lie to you. I would say these are complex, but I've got some nice language for you, my friends, and some nice English, plain English for you at the end here. And I'm going to explain a little more in depth. So the gamma is going to be the first derivative of delta. So these two are going to be very correlated. Essentially, they work together in calculating the profit. So first derivative of delta is used when trying to gauge the price movement of an option, but it's relative to the amount it is in or out of the money. In that same regard, gamma is the second derivative of an option's price with respect to the underlying's price. When the option is being measured to deep in or out of the money, gamma is going to be small. So basically, you don't really need to understand any of that, to be honest with you. Yes, when you go and get more advanced, yes, you can go ahead and compare all of these and determine, you can calculate exactly how much you're going to be earning by point movement in the actual stock price. Yes, you can do that. That's fine. You don't need to, in my opinion. It's fine if you want to do that. That's great. You get options guru are crying right now, like, oh, Brandon. All right. But profit is gamma combined with delta, essentially. That is essentially, to me, that's basically what you need to know in terms of delta and gamma. Also the theta here. Depreciation, also known as time decay. So basically, as I said, if you're going to do out the money options, you need to be aware that you're going to lose value on that contract over time. Also, number 12, this is the most important thing in this entire video, maybe, okay, besides the in the money, out the money risk management there, probably. There is much more advanced information. This is literally just an extremely basic understanding of options in regards to how they work. And of course, if some options guru, I'm going to be honest with you, there are going to be some people in the comments that know more about options than me. I don't do options very often. I don't know, I'll do options typically. Typically, I usually have one option open. For the last month or two, I've had options going for a while, open at least. I've had them available to exercise or sell. I've had them purchased, but I have not, since I got rid of those, since we kind of started bouncing. I have not actually picked anything up really. I can see myself definitely opening up some leaps, which are basically just long-term, high risk, high reward, not really high risk, but high premium, long-term option plays with high volatility, high reward, with not that much risk. So but it's a high premium. That's the downside there. But there's much more advanced information, my friends. So please go down the rabbit hole if you are considering getting into options. And also, why I didn't have this point here, but is it worth it to do options, right? Are options worth it? And how do you place one? Okay, I've already shown you how to place one. Just to recap, you just go to any stock, you have their chart here, you pull up their widget on Webull here, you can go to the widgets, okay, you can click this, add a widget, 7,000, Webull has everything you want, link in the description again, quick plug there again, I'm sorry my friends, but on the chart here, you literally just click an ask of something, and there you go, okay, you can click the bid if you want, and you can sell, obviously we're not trying to do that, so you click on the ask here, and you can get your call options, purchase them, so yeah, they are worth it to do once you know how to do them, my friends. If you are just dabbling, I would just do one contract. And remember, one thing we didn't cover here is one contract is 100 shares. Okay, so 10 contracts would be not 100 shares. That would be 1,000. So one contract, 100 shares, $141 premium. I would recommend doing at the money or in the money. Do not go low strike price. Also another thing, the farther you go out, the farther you go out in day, like if you were to do a 20th of January 2023 out the money call option, let's see how much this one is going to cost. $2,700. Let's see how much an in the money one would cost. $4,000. Okay, what about $3 strike price? $5,000 in premium for, let's see how much it would cost for even 100 shares, 520. Okay, that's more than the out the money ones by a ton. So obviously, guys, as you go farther in time, you get more chances. The more time there is, the more chance your stock is going to just bump up to that price where you're really profitable, giving you a chance to sell. If you're paying attention, boom, there you go. So the more time you have to do that, potential for that, the less risky it's going to be, the more potential, the more premium you're going to have to pay. So keep that in mind as well. We're not even going over leaps here, but this is just a basic tutorial. Let me know if you want more in-depth options. I can go more in-depth with them. Also, we can do live streams when I actually place options for you if you want. But please do more research. Go to the rabbit hole. I'm not the best person to go down the entire rabbit hole with, because some of this stuff, I'm going to be honest with you guys, this is why I'm so honest and transparent. I don't even know what some of this stuff is. Okay, I'm just going to be honest with you. Iron butterfly, bruh. It's like, what does this mean? It's like, I don't know some of the stuff. And I remember the first time I looked at this spreadsheet here, it's like, bro, I know, guys, it's hard. There's watch some videos. You just watch a couple videos, take some notes. It's not that hard once you get it. It's not that hard once you see how the actual process works. So also on the Webull app, I recommend doing it on a desktop, because the Webull app, I don't like the Webull app version. I like this version much better. You can customize things a lot better. It's a lot more options. You can see the volume very easily. You can see everything really easily. And also make sure you change it to just calls. You don't want to have both. That just makes it way more complicated. Okay, then you have calls on the left, puts on the right. You have all this information here. Just go to calls so you know you're not going to screw yourself over. Click on the ask of an in the money or at the money contract, or in the money strike price, and one quantity. I recommend doing a very cheap premium, not cheap premium, but very cheap amount if you don't know what you're doing, and if you're dabbling in. There you go. Disclaimers: I am not an options guru. I can always be wrong on stuff. Please fact check me below if any of this stuff is wrong. Tell me below, and I will pin it in the comments or whatever. I'll clear it up. I can always be wrong on stuff. Do your own research before investing, and do your own options research before doing an options. Okay. Also, portfolio showcase, all this stuff. Okay. Account. Here you go. My full account, my friends. I show my entire portfolio history. The last couple of months, I'm up 40%, killing the NASDAQ right now, at least. Price targets. Here you go. We've already hit one end of year price target for Microvision, my friends. And relevant information in regards to the title is finished now. What do we do now? Set a reminder for Thursday and Friday live stream. How do you do that, you may ask? Just go to my little channel here, the awesome Auspicious dissenT channel. Go to upcoming live streams. If you're on the desktop, you just have to scroll down a little bit. If you're on phone, you just have to go to videos, and then you can go to uploads, and then upcoming live streams. There you go. Also, you can go to the community tab, and then I'll have someone posted there sometimes. Just go to them, set your reminder. There you go. Boom, boom, boom. Also, I'm doing plug. This is the plug section. Okay, do this stuff if you want Reddit and Dead Inside. Check the Reddit link. I'm going to link in the description as well. Go upvote that post, because it is going to actually directly increase the interest and potential stock price of BNGO in a non-corrupt way, objectively and patently. So anyways, this is not financial advice. Thank y'all so much. I will see y'all in the next one.